Hey everybody, welcome back. We are on Unit 4, the financial sector. We are on subunit 4.2. This is the nominal interest rate versus the real interest rate. Okay, the nominal interest rate and the real interest rate, trying to understand the difference between the two. I've got this little visual to help us out with it, okay? This is nominal interest rate equals the real interest rate plus the inflation premium. Let's start with the nominal interest rate. Let's define that. First, guys, the nominal, anytime you see nominal, that means unadjusted for inflation, right? Unadjusted for inflation. So the nominal interest rate is the interest rate unadjusted for inflation. So there you go, that's an easy definition. A couple other things I like to say that the nominal interest rate is it is the interest rate printed on the debt contract. What do I mean by the debt contract? I mean the mortgage, I mean the bond, I mean the car loan. So this is the interest rate printed on the debt contract. This thing's not going to change, all right? Finally, the nominal interest rate. Now, I'm going to say this kind of like from an annual standpoint, okay? So from an annual standpoint, the nominal interest rate is the percent increase in dollars the lender is going to receive or the borrower is going to have to pay, again, on an annual basis. So the nominal interest rate is the percent increase in dollars the lender is going to receive or the borrower is going to have to pay, either way you want to say it. The real interest rate. Well, when you see real, okay, that means it has been adjusted for inflation. So this is the interest rate adjusted for inflation. Now I'm going to say a couple other definitions here. I'm going to start off with from the lender's standpoint. From the lender's standpoint, the real interest rate is the expected, and that is key. It is the expected. We do not know this. It is expected. It is the expected percent increase in purchasing power the lender is expecting to get from the loan. Once again, on an annual basis, okay? What else is it? It is the expected percent increase in goods and services the lender's expecting to be able to buy from this loan, again, on an annual basis. And then finally, from the lender's perspective, it is the expected real rate of return of the loan, okay? The expected real rate of return of the loan. The real interest rate from a borrower standpoint, I'm just going to give you one definition, pretty straightforward. It is the expected percent increase in goods and services the borrower is expecting to have to forego on an annual basis. So, what I'm saying there, guys, is, and I'm going to use this little timeline right here, the borrower who borrows some dollars here at T0, why did they borrow the dollars here at T0? To go buy goods and services. That's why we borrow money, is to go buy goods and services. So they borrow dollars here to go buy goods and services. They're going to have to pay back some percent increase in dollars, the nominal interest rate, and those dollars could buy some percent increase in goods and services, okay? And so that's what I was talking about with that definition of the real interest rate from the borrower's standpoint. The inflation premium. This is the expected or forecasted inflation rate, okay? The forecasted inflation rate, okay? This is basically telling us how much we're expecting the value of the dollar to go down over the course of the loan. Now, as we go forward, I want you to understand, as I start talking about loans, I'm going to be talking about loans that are just 1 year long. I'm just doing that to keep things very simple so that we can get the concept, okay? Now, as we talk about things, I want you to keep this in mind, and I kind of just talked about it a second ago when I talked about the inflation premium. The value of the dollar varies inversely with the price level, okay? So once again, what I was saying before, this is the forecasted inflation rate. The inflation rate is the increase in the price level, right? And so this forecasted inflation rate is telling us how much we expect the value of the dollar to go down because they are inversely related. The price level and the value of the dollar inversely related. Okay, we're going to walk through some examples. I think that's what's going to really bring it home for you, okay? So let's go ahead and fill out this table. Let's say that we have a loan where the nominal interest rate is 6%, okay? And let's say that the forecasted inflation rate is 2%. Well, that means that the expected real interest rate must have been 4%. All right? So that's printed on the loan. Both of these are expected or anticipated. Now, the actual inflation rate ends up being, we're going to say something different than what was expected. Remember, these things we're thinking about in relation to T0, but then time passes, right? The time passes, we can get an inflation rate that is different than expected. Let's say we get an inflation rate of 4%. So that means we're expecting the value of the dollar to go down by 2%, but it ended up going down by 4%, okay? So let's think about this, okay? Let's think about it from a lender standpoint for a second. They're going to lend out some amount of dollars. They are going to get 6% more dollars, okay? They are going to get 6% more dollars. This is printed on the debt contract. Now, they are expected each of those dollars to lose 2% in value, allowing them to buy 4% more goods and services. However, the actual inflation rate ends up being 4%. The value of those dollars goes down by 4%. So they get 6% more dollars. The value of each of those dollars goes down by 4%. They can only buy 2% more goods and services. We get to this last column right here. Who's hurt, who's helped, okay? Who's hurt by this? The lender. The lender was hurt by this unanticipated inflation. Now the borrower, hey, they're helped. They're happy, guys. They borrowed dollars here. They have to pay back 6% more dollars here. They were expecting that asset that they had to pay back to lose 2% in value. It actually lost 4% in value. Hey, from a borrower standpoint, they're going to have to work less to pay back this loan than they were expecting. They're going to have to work less to pay back this loan. So the borrower is helped for sure. Okay? Now, let's do another example. Again, I'm going to stick with 6%, 4%, 2%. But I'm going to say the actual inflation rate ends up being 1%. So again, we're expecting the dollars that we're going to be paid to be worth 2% less, but they're going to end up being worth 1% less, okay? Don't get confused. That 2% means the price level or the inflation rate is 2%, which means the value of the dollar is going down by 2%. But it ends up that the price level only went up by 1%, so the value of the dollar only went down by 1%. So what does that mean? That means from the lender standpoint, guys, hey, they're going to get paid 6% more dollars. That is what is going to happen. Again, they thought each of those dollars would be worth 2% less. Hey, but they're only worth 1% less. So that means that the percent increase in goods and services they're going to be able to buy, 5%. They were expecting to only be able to buy 4% more goods and services. They're expecting their purchasing power only go up by 4%. But it actually goes up by 5%. The lender is helped. They like it when that actual inflation rate ends up being less than anticipated, okay? Lender help. The borrower, of course, hurt, okay? Why is the borrower hurt by this unanticipated inflation, okay? They thought the asset they were going to pay back with, okay, they knew they were going to have to pay 6% more of that asset. What is that asset? It's dollars. They thought it'd be worth 2% less. It was only worth 1% less. That asset ends up being worth more than they thought it would be. They're going to have to work more than they thought to pay back this loan. Okay, one more I want to do here. Okay, I'm going to put 6% again. Okay, I'm going to go over to this one. I'm going to put negative 2%. Oh, I'm sorry. I don't want this to be 6%. I'm sorry about that. I'm going to erase that. Let me go with negative 2%. Let me keep this being 4%. Okay, if that's 4% and that's negative 2%, this is going to be 2%. Okay, this is going to be 2%. So, little different situation here. What does this mean? This means that we're actually expecting deflation, okay? Once again, inflation rate of 2%, inflation rate of 2%, we're actually expecting deflation here. So we're expecting the price level to go down, so that means we're actually expecting the value of the dollar to go up. So what does that mean? The lender, they're going to get paid 2% more dollars, but hey, those dollars are going to be worth more in value, 2% more in value. So they're getting 2% more dollars, each dollar is going to be worth 2% more. They're expecting to be able to buy 4% more goods and services. Now, let's say that the actual inflation rate ends up being 0. The actual inflation rate ends up being 0. The price level doesn't change at all. The value of the dollar doesn't change at all. So what does that mean? That means the lender's going to get 2% more dollars. Remember, the nominal interest rate, percent increase in dollars the lender will receive. They're going to get 2% more dollars. Guys, they're expecting those dollars to go up in value. Remember, that negative 2 means the price level is going down, value of the dollar going up, okay? However, the value of the dollar did not go up at all. So they got 2% more dollars, value of the dollar didn't change. They're going to be able to buy 2% more goods and services. The lender is hurt. They're expecting to be able to buy 4% more. They're only going to be able to buy 2% more. The borrower, again, helped. Now, make sure you got it. Here's the deal. Here's my expected inflation rate. If the actual inflation rate ends up being higher, okay, if it ends up being higher, guess what? Lender hurt, borrower helped, okay? We saw that here and here, all right? If the actual inflation rate ends up being lower than expected, lender helped, borrower hurt. Okay, I know that might have been a little bit difficult to follow, but I promise if you watch that twice, you will have it down. Those numbers will make sense, okay? Anyhow, thanks for tuning in. We'll see you in the next video.